Okay. So one of the so we are listing out the decision problems, and one of the principles we had applied when we had discussed taxonomy is that your high level categories should be as few as possible.
He is Rajat Jain's brother name.
So,
Sir, he is facing problem to enter the meeting.
okay, Rajat wants to join in his brother's name.
Yes,
Yes,
sir.
sir.
Okay. Okay. 1 minute. So first, I have to mark Rajat absent for today because he's joining late. This is day 6.
So,
Yes.
सर उसने लेट ज्वाइन नहीं करा, उसने मतलब राघव ने ऑलरेडी मैसेज भेजा उसके बिहाफ पे कि उसको प्रॉब्लम हो रही है, टेक्निकल ग्लिचेस हो रहे हैं इन द चैट बॉक्स.
What is the problem? He had what? I don't remember Rajat joining.
Sorry.
I don't remember Rajat joining before a deadline.
Sir, he is having a technical glitches. He is not able to join the class on the time. Raghav sent the message on the chat box too.
Raghav, okay.
Yes, sir.
Okay, now this is the problem with these Zoom meetings. Is there's always a risk of this technical problem. Okay, so let me. Okay, so we'll leave it out for now. We'll have to. Okay, all right. So we'll. Where was I now? Okay, so we were discussing this the decision problems. So some of these, your high-level category should be as few as possible. That's why we have classified some as sub-decision problems. So whether you use FA or TA is a sub-problem under the DP4. Okay, that's why this is how it's done. So similarly, this is the question that Siddharth asked about pyramiding. That is a sub-decision problem under the DP7. Okay, and this will have. So this I'll just carve it out later on into a separate note. And there's a term. So pyramiding essentially means, as you can see here, I'll just briefly add to what we discussed that day towards the end, that when you have a winning position, first time you do a trade, your position moves into profit, and then so if you buy something here initially, you put a stop loss over here, and then you find the market has moved up, but you're very bullish. You think it's going to go up even more, so you don't sell this what you bought here. You buy more. Okay, so this is called pyramiding. Okay, so the term that we use for pyramiding is only for winning position. Okay, and there is another term that you should be aware of in the context of. I'm putting it in the previous day's notes itself. The other term that you should be aware of along with pyramiding is there is a term called averaging. Okay, I'm just telling you this, but this is a very it's a very bad habit. So I totally recommend against doing this, but you should know the terminology. Averaging, losing trades. Okay. So this is basically what happens is this here. I'll just explain visually what it is. Everyone understands, I hope, about what is meant by original lot. Original lot means I bought one lot, my first lot of shares I bought here. Let's say I bought 100 shares and now it's gone up. I'm now talking about buying more lots, like another multiples, few more multiples of 100 shares I can buy. Okay, so that decision making, there's a logic involved there. But at this stage of the game, we are not going to discuss that. Or maybe we should actually. I will discuss it because I think it's relevant for your project. We will discuss it. I thought we would treat it as an advanced topic, but you may come across this position, this kind of a situation. So we'll discuss it right now, actually, and we'll recap this. The other term that you need to know is called averaging losing trades. Okay, which is what happens where, let's say you buy here. Okay, you buy here, and then you don't really. This is very bad trading style, very bad trading strategy. But I'm just making you familiar with the terminology. Okay, so I totally recommend do not do it. Okay. So what people do is they don't have a plan for cutting losses before entering. They buy it here thinking it'll go up, but it doesn't go up, it starts dropping. Then when it comes here, they say, okay, now it's even cheaper, so let me buy some more. All right, so your original lot is already losing money, and now you're buying more. Now you buy it at 12. And then what happens? Then it keeps on dropping, and you say, oh, it's even cheaper. Let me buy some more. Okay. So you buy another lot here. So this is what you call averaging losing positions. Okay. So this is how a lot of people trade. Okay. Rajat has also entered the waiting room. Okay. All right. So now this is what happens. So this is what is meant by averaging losing positions. So when we say pyramiding, we are referring to winning positions. And when we say averaging, we are typically, you can also call it, you can also refer to pyramiding as averaging winning positions, but it's better to use averaging usually it's used for averaging losing trades. Okay. So this, we will just write the definition. Okay, now Jakar is definitely absent because Jakar is, okay, I've allowed him to enter. Okay, now, all right. Now, what was I saying? Averaging losing trades. Yeah, so we'll just add the definition here. Okay. This lot should be actually more positions. So this is also a term you need to be familiar with. I'm using this term. This is called market lot. Okay. This is also a term you should be familiar with. Market lot means.
Hello, sir.
Yes.
But sir, averaging can be used like if I have to invest 10,000 in a share, and on first day I invest 3,000 to watch the movement and to study, and I don't want to invest my whole money at one go. So I wait for some time and then I invest again. So sir, it may be a useful strategy.
Okay, I understand what you're saying. I'll just address your point. I'll just explain the averaging and I'll address your point. Yes, Mithali, what is your question?
Sir, in averaging, you have written adding more positions when original lot is profitable.
Yeah. Actually, I was just copying it from there, and now I'll change it. Okay. We'll make it when. Let's put it original. Let's make it previous lots are trying to be grammatically correct, are losing money. Okay. Adding when original previous lots. I'm coming to Vipul's point. Vipul has made an important point. Okay. When original lots. So all this will later on go into a separate note. So this will not be cluttered, but I'll do that later. When which will be linked to the note will be linked to here. When original previous lots are profitable. Okay. All right. So let's understand this properly because this problem will come up in your trading. Okay. So pyramiding winning positions, adding more positions when original previous lots are profitable. Okay. There's a sub decision problem under DP7. Okay. Averaging losing trade, adding more positions when original previous lots are losing money. Okay. Now, let me just briefly, I'll define market lot. Now, what this, okay, this is, let's go to caps. Okay. So when we talk about averaging and we talked about the typical behavior of unprofessional investors or sometimes even professional investors, this kind of behavior, you buy something here and it drops, then you say, oh, it's even cheaper, let me buy some more here. Then you say it goes down further, then you say it's even cheaper and let's buy some more here. So your average cost of acquisition is going down, that's true. But your position size is also becoming bigger and bigger. Okay. So, and you're still losing money on a net basis. So this is why I say this is totally not recommended. Okay. So you should understand what this is. Absolutely bad strategy done without a plan. Okay, so I say do not do it. Okay, ever. Now, what did this is, let's say, averaging losing trades. Now I'm going to make a distinction between this and what Vipul said. Okay, averaging losing trades is different from a pre-planned um, scheme of entering targeted position. What Vipul is talking about is total targeted with total position size. Okay. You understand what scaling in is, okay? So Vipul has actually already, he has used different language, but what Vipul talked about is, he talked about a targeted total position size. He says that I have a targeted total position size of, let's say, 10,000 shares, okay? I have made a plan that I will buy 10,000 shares in this particular stock, okay? And by the way, whatever we are discussing, unless I qualify the statement, it applies to every kind of asset class, market, instrument, everywhere, okay? So we're discussing with respect to stocks because your project is in stocks, but this applies everywhere, okay? Currency trading, bond trading, commodity trading, everywhere. Futures, options, everywhere, okay? So now what Vipul is saying is averaging is different from a pre-planned scheme of entering targeted total position size by scaling in entries via multiple lots. Okay. So what is Vipul talking about? His targeted total position size is 10,000 shares. Now what he's saying is he's going to scale in entries via multiple lots of say 2,000 each, or yeah. So let's say he buys initially 2,000. So what he's saying is, Vipul is saying that I want to buy total of the 5 total of say 10,000 shares. Okay. Now what he's saying is I'm going to buy some right now at the market. Okay. But I have a plan. There is a larger plan, and that plan has to include a stop. Okay. So he will have a plan, let's say, to buy at 1470, 2,000 shares. Maybe I had to buy at 13, 2,000 shares, to buy 12, 2,000 shares. Okay, so on and so forth in 5 lots. So instead of buying 10,000 in one lot, he buys 10,000 in 5 lots, and he should have the whole thing has to be pre-planned. So the distinction is basically between done without a plan. Okay, usually what happens when typical investors invest, the retail investor, not just retail, but sometimes professional people also do it. They don't really have a plan on the defensive side for risk control. They buy it, and then the market goes down, and they say, oh my God, what will I do? It's not working out. Let's buy some more. So everything is happening on an ad hoc basis without any previous planning. Okay, this is the problem with this kind of investing. So the distinction really is between planning and no planning. Okay, so pre-planned scheme, what Vipul is talking about is a pre-planned scheme by scaling in entries via multiple lots. Okay, so this is what Vipul is talking about. This is fine. Okay, this is fine, but the scheme should include a stop. I'm just going to use the word, let me just use stop loss here, layman's terms. Okay, stop loss for the okay, so and this must respect, okay, maximum trade risk limits. Okay, if you remember, towards the end of the previous class, okay, so what I'm saying is, if you look at the discussion we had the other day, okay, at the end of the previous class, we were talking about how will you decide your position size. For that, you need to decide the maximum risk per trade. And from there, you decide your position size so that you do not breach this guideline of 4286 in this example. Okay. So this kind of thinking. Now, therefore, what I'm saying here is what Vipul is saying is absolutely fine. Okay. Let's put it this way. This scheme has to include a stop loss plan for the targeted total position size. Okay. This is what I'm saying. All right. So this is as long as you can do that, which means basically what's happening is if you go back to the earlier discussion from the last part of the previous class, we were talking about Sachin is buying FCX. Okay. How many shares can he buy? So we went through this calculation. We can recap this once again. We went through this calculation and we arrived at so what we are saying, what we discovered is this decision problem regarding the number of units and position size. I'm looking at the calc file right now. If anyone can't see it, they should tell me. Otherwise, I assume that it's working. Okay. So when we discussed the decision problem, one of the last decision problems is how many units should I buy and how do I solve that decision problem? So for that, we discovered that we have to first also arrive at this point of this important calculation of maximum risk per trade. Okay. And then we use that. So we can't arrive at this solution to this question directly. We arrive at it indirectly. And we use this, and then from this we arrive at some number like this. Okay, later on we'll put it into an algebraic formula, but for the moment you can look at it as a trial and error thing. So these kind of calculations, guys, you have to set up your own spreadsheet. Okay, there's a reason I don't make this copyable and all that. I don't want you to do shortcuts by downloading my spreadsheet. You can use my spreadsheet as a reference point to check that your formulae are correct. But you must practice doing it yourself. Setting up your own doesn't take much time. Otherwise, you will not learn. Okay. So remember that you can't fool yourself. You can fool the teacher, you can fool DSB, but you can't fool yourself. So if you don't practice, then you will not learn. And then at the end of the day, the companies are not going to hire you. Okay. So we discovered here it's 4286, it's 4183. Maybe he can do a little bit more. This will not be trial and error. This can be put into an algebraic formula. Okay, so we can make it 2110 4286, and in this manner, Sachin will find out. Basically, it will be a little bit more than this. So eventually we find out the position size. So the point I'm making about the point that Vipul made is perfectly fine what he's thinking, but it should also be subjected to the same kind of analysis. So first, Vipul has to do this analysis that this larger trade that I'm planning, what is the maximum risk for the larger trade? And therefore, what is the total position size for the larger trade? And then accordingly, he has to, because the stop loss will be only one stop for all the trades. So this analysis is slightly different, slightly more complicated than this, but the concept is the same. He will have to, instead of splitting up the position size, if you remember, if you notice what Vipul said, that I want to buy 10,000 shares, and then I will buy it in lots of 2,000, something like that, he said, right? So the example I gave you was along those lines, 10,000 shares total, but buying in 2,000 share lots. But actually what he has to do is the equal division has to be based on the risk capital. So the total risk is 4286, and he wants to buy this total position in 5 lots. He has to really split up the risk capital. Okay. Now this is the normal way of doing it. If you want to have unequal risk on equal different positions, different lots is fine. But I would suggest keep it simple, go for equal risk. So what you do is you divide the risk capital into 5. If you want to do this trade in 5, you want to scale in 5 lots. Then you divide the risk capital into the risk per trade, you divide into 5 lots. So now what Vipul will have to do is, first lot, I can risk this, if we take this example. Okay. So first he has to do this. So what he has to do is basically, okay, so each lot can only risk this much. If you go by equal risk, you can also go for unequal risk, but this is a simpler way of doing it. We're not complicating it further. So each lot can only risk this much. So then Vipul has to separately calculate. There's only going to be one stop. Let's say the stop is here, $5. Okay, I'm just giving a crude example. And Vipul wants to buy one lot at 14.70, one lot at 12, one lot at 10, one lot at 8. That's his plan. So he has to make up the prices. He has to decide the prices where he will enter. Okay. So one will go with a market order and the rest will go with limit orders. So then he has to decide basically that, how much can he buy on each of the lots. That will be determined by the same kind of calculation. Instead of 4286, you write 857, and then you figure out how much can go into each lot based on the stop loss that you have. You have an entry price, you have the same stop for all the positions, and you have multiple entry prices. So you go through the same logic we went through the other time, which is loss per share, and then a total number of shares that you can buy given that you can't lose more than this much, okay, 857. Okay. So this is an important point that Vipul has mentioned. That's a good point, that you can also have a plan to scale in the entries via multiple lots. Okay. But as you notice here, this is the difference here between the two approaches. Here there is a pre-planned scheme, and this averaging business is done without a plan. This is the main thing. And you notice that all the pre-planning, everything is anchored in this. Okay, everything is anchored in this maximum risk per trade. And where does the maximum risk per trade come from? It comes from the risk capital. Okay, so you can see here, this is the most important factor, not the percentage part. Okay, this part. All right. So this is actually what is driving your position size and your risk-taking ability. Can you see that? Obviously, you understand if you go back to the point that Sachin was making the other day, that these things are not moving that much, and in the short period of 5 weeks, they will not move much. So how can we make money? Obviously, answer is you have to take bigger positions, but then the other problem is if you take bigger positions, you lose money, then your drawdown number will go up. Okay, and that will increase your denominator and that will decrease your score. So there's a double-edged sword. Okay, like most things in life, you're walking a very tight balancing. You're performing a tight balancing act. You have to you have to lean a little bit to the left, but not too much to the left. You also have to lean to the right. So it's a balancing act. Okay, but that's life, and this is what trading is about. So you have to balance that. You have to learn to balance that risk. Okay. So if you see what Sachin was saying, that what was I saying? What was the point that Sachin mentioned the other day? Why did I bring up Sachin's point? Yeah, so he was saying that you're not making enough money because the movement will not be much, so you have to increase the position size. And then, but whatever you do, the point is that you have to do it with a plan. Okay, so everything, and so yeah, so what Sachin was talking about. Now I understand what the connection was. That I was talking about, what I'm essentially saying is that your capacity to take risk. So what Sachin is saying is that because it's not moving much, the absolute dollar price movement is not much, I will take bigger positions so I can make more money. But when you take bigger positions, you're also taking more risk, and then risk and return go together. Okay. So generally, if you want to make higher returns, you will have to usually take more, generally, not always true, but generally. So here, if you take bigger positions, you're taking more risk and you're trying to drive your higher return. So the point I'm trying to make is that here you see your risk is actually defined a lot by your position size. There are other factors also, like stop loss versus entry price. What is the distance between that? Okay, this P&L per share. But this is a big factor determining your risk, the position size. And what is determining the position size? The maximum risk per trade. Okay. And so position size is not something you get up one morning and say, good man, I feel good. I had 4 coffees. I'm feeling great. Let's buy 5 million shares. You don't decide that position size like that. You decide it mechanically almost from the maximum risk per trade. And the maximum risk per trade is a function of, let's check. Okay. Number of losing trades here. This is, I want to close this. Yeah. So it's a function of total number of losing trades that you're projecting. This is a projection. Remember, these are projections. Okay. This is not a projection. this you decide beforehand. It's in your hand. It's not a projection. But projected number of trades is a projection. It's a guess. This may not turn out to be correct, but you can still control this. But you can't control percentage losers. Okay, and so you can't control losing trades. It's a projection, but you still need to make a reasonable projection. So your maximum risk per trade depends on number of losing trades and the total amount of risk capital. Okay, so you have to understand this. So the point I'm trying to make after this long discussion is that this will go into the market law. I'll come to that. Now we go into today's discussion. That this is the point I'm trying to make, which you have to understand. That so this continues the discussion on position size and pyramiding. Okay. Well, let's talk about. Okay, so it's position sizing. We are discussing the position size problem. So the point I'm trying to make is number of units position size, and the point I'm trying to make here is this long discussion why I showed you all the connections is that your ability to take risk and generally therefore to generate returns. Okay, so this is to show that risk and return go together. Okay, ability to take risk and generally therefore generate returns is constrained by constrained largely because the number of losing trades is also a factor, largely by your, let me just save this is what I wanted to say actually. All right, so that your ability to take risk, okay, and generally therefore generate returns, okay, is constrained largely by your risk capital amount, not by the and not by the investable capital. All right, so your ability to take risks, and so what is the risk taking? I mean, basically risk here we are using proxy position size as a important proxy for risk. Okay, so here position size is taken as a important proxy for risk, as you know, as one important proxy for quantum of risk. Okay. All right. So I hope people are following what we are discussing because here I don't have the luxury of seeing your faces to see who is looking confused and who is not looking confused. So let's just make, Priya, are you able to follow what I'm saying so far? Yes, Priya has gone to sleep.
No, sir. Actually, वो unmute हो रहा था. Sorry for the late.
No, okay. Now Jakhar has entered. Okay, once. Yes. So Priya, are you able to follow what I'm saying?
Yes, sir.
Okay, good. All right. So just make sure. Please make sure that you guys ask me because here I can't see your faces. So you have to ask me when you don't understand something. Okay. So what I'm trying to say here, position size is one important proxy for risk, for quantum of risk. Why am I writing it like this? Because the other factors that determine the quantum of risk are also things like the distance between the entry price and the exit price. Okay, so that's why I'm just writing. So position size is one of the determinants, but this is also a determinant. Okay, so that's why I'm writing. So this, after all this discussion, the only point I wanted to make was that the position size is that your ability to take risk is constrained This is the point I wanted to make basically, so that you understand this. And it also helps us to understand the difference between investable capital and risk capital is constrained largely by your risk capital amount. Okay, this is what we are saying, and not by investable capital. And so here position size is taken as an important proxy for quantum of risk. Okay, yeah. So this is, I just also let me quickly make sure that everybody understands here the difference between risk capital and investable capital. So let's ask somebody. Okay, Gaurav, what do you understand as the difference between investable capital and risk capital?
Sir, investable capital is what you have, what you can invest, but risk capital amount is what you actually invest, keeping in mind your risk capital percentage.
No, I didn't ask. I understood the investable capital part, but the risk capital part, I didn't really understand what you're saying. Can you say it again?
Risk capital amount is what you actually invest, keeping in mind what percentage of what is your risk preferences. So how much do you want to risk?
No, this is not correct actually. There's not much difference between a definition of IC and RC. We'll call it IC and RC, invested capital. Either it's investable capital or it's invested capital. Okay, we can use both the terms. Okay, I'm coming to, people who have raised their hand, one sec, I'm just coming to that. We'll start with RAG first, but let me just write it, investable or invested. Okay, sometimes we can use invested capital. They more or less have the same. So investable or invested, basically invested is past tense. Okay, and investable is what is available. I have say 10 million available to me, free funds available for investing, that is for buying assets. Okay, or putting up margin for selling assets. This is investable because I have it available. I have not yet deployed it. Okay, and invested, this I'm not going to write down. You should understand it. And invested, this is just a kind of this is past tense. That once I spend out of that 10 million, once I spend 5 million to buy a house, then I've got the invested capital is 5 million in that house. Okay, so that's invested, which is after the fact. So that's what it is. But we are trying to. So yes, Rack, what is your answer?
Sir, am I audible?
Yes.
Sir, I just wanted to ask something about risk capital. Sir, is it that, for example, our investable capital was 10 lakh and our risk capital is 6 lakh. So we are prepared to risk 6 lakh of the amount, and we are like prepared to like if we lose 6 lakh, then we are prepared to 60% of was our risk capital, but the other 4 lakh we want to deploy only in safe investment.
Correct. You're correct. You're absolutely correct. So this is the correct definition. So Gaurav, please take note, and everybody else also please take note. Okay, so this is the correct definition. Okay, so let me just write it down here also, so that so invested capital, investable or invested capital. This is an important distinction. You will not find it in the books, but it's a very important distinction to make, and I'm sure you will all agree. Okay, this I've already explained. Funds available or deployed, okay, in investments or margin. Okay, normally we say investments, we have the sense of having bought something, okay, but since here in this whole approach to finance, we don't want to be biased to one side. Okay, we can buy, we can sell. Okay, as you will see in the case when we go to currencies. Okay, when you buy one, and you should have already done your readings by now. If I buy the euro, okay, then I'm selling the dollar. Okay, so you always remember markets are a venue for exchanging assets. So when you buy one asset, you're already also selling another asset. Okay, so there is never just buying something. You're always selling something as well. So if I buy a house in Calcutta, I'm buying the house and I'm selling rupees. This is clear? Everybody understands? Okay, this is how you should understand it. So that you never buy anything alone. You're always selling something also in every market. Okay, as I said, if I buy a house in Calcutta, I buy the house, but I sell rupees because I pay money for that house in rupees. So here, if I buy the euro, I'm selling dollars. If I sell the euro, I'm buying dollars.
Dual concept, sir.
Sorry, yes, Sachin?
It's a dual concept as we read in accounts, as study in accounts, dual concept. Double entry.
Use the term dual concept, but it's basically
Double entry, I guess.
you should always understand it as that. Remember, we gave you the definition of markets. A market is a venue for exchanging assets. So this is there in your readings. I'm not going to write it. If you go through your readings, you'll see it is in your readings here. Okay, transactions as contracts to exchange assets. You do this reading, you'll find it. Okay, so every here we define markets. Okay, in these initial readings, that markets are a venue for exchanging one asset for another, and a transaction is a contract to exchange assets. So when you buy something, you're also selling something. You may not realize it. When you go to the market and you buy sugar, you're actually buying sugar, but you're selling rupees. All right. And the guy and the sugar merchant who is selling it to you, he is selling sugar and buying rupees. Okay. So you look at it from both sides. So that's basically the right way to look at it. I would not call it a dual concepts. All right. Okay. But this is the way to look at it. So the point I was saying here is, so funds available or deployed in investments of margin. The reason I wanted to use the word margin also is investments has a sense of only buying things. Sometimes you put up margin to basically margin funds, let's put it in, where to when you're going short something, okay, when you're selling something which you don't have, but you have to put up the margin to be able to do that trade. So basically funds deployed, either funds available or deployed. So available, then you say investable, or invested. Once it has already been deployed, you call it invested capital. Okay. So as Rag clarified, this is the right definition. This is available. Okay. And risk capital is basically what you are willing to lose, okay, in a period. Okay. See, so the point about risk capital is basically that it should be something. Remember, as you do when you do any business, most of you come from business family, you understand the concept of risk. Everything you try out is not going to work out. Okay, even big companies like Google, Amazon, they've had products which don't work out. Okay, so Google's social networking thing did not work out. A lot of other things didn't work out. So therefore, just because you're launching a product or starting a business, it doesn't mean that it will work out. Okay, but you budget for that. In a business, you have a concept of risk capital, that you understand that, you know, when I start this business, I'm going to lose money for the first 3 years, and I may lose maybe $10 million in the first year, 15 in the second year, and 3 million in the last year, or 5 million in the last year, in the third year. So I'm okay with that. Because I see in further down the road I'll make money. Okay, so when you do business, obviously, because you are willing to lose some money, and it should be a budgeted loss. Okay, it's basically like a budgeted loss. Okay, that's what I'm saying. So it does not matter. Okay, if you lose this money, of course, yeah, you don't want to lose money, but it does not affect your business operations. Okay, so these are obviously done for every period. Okay, these are defined for periods. Okay, period means that 1 year, 1 quarter, and so on and so forth. In this case, you have investable capital of 1 million available for about 5 weeks, okay, in your trading project. All right, and then how you define your risk capital, this I'm leaving to you. I'm not forcing you to say this. As if you remember, Rag also used an important term. I think Rag or Gaurav, maybe Gaurav used it. That concept of risk preferences. Okay, so risk capital percentage. Okay, let's put it this way. That these are defined for specific periods. Okay, so when you say my risk capital is say $1 million. Okay, now that statement is not complete. You have to also mention to which period does that apply? Is that available for your next 1 year of trading, or is it available for the next quarter of trading? So these are defined for specific periods. You have to also mention the period. In this case, 5 weeks. And risk capital percentage. This is a function of, okay. Chakar keeps getting knocked out of the room. All right, okay. Is he in? Jakar, you're in the room? Okay, we'll see about that. Okay, all right. So risk capital percentage is determined by investors. Not very good English here. But here we're just writing broken English just to make sure you understand the key terms. Determined by the investors. Let's try to, okay. By the investors, this is a term that I think Gaurav used. Risk preferences, okay? So he could be, you might have heard these terms, risk averse, okay? Risk prone. Risk prone means risk seeking, okay? So risk averse, we normally say risk seeking, okay? So you could be somebody who is very aggressive. He likes to take a lot of risk. So you can see somebody like Elon Musk. Nobody would describe Elon Musk as a risk averse guy, okay? So he's definitely somebody who's an aggressive risk taker. So that's what I mean by risk preferences, okay? So you decide this and also based on other circumstances in your life, which basically determine your risk preferences. So whether this number should be 60% or 70% or 80%, 90%, that is for you to decide. Each student will decide it for himself, okay, how he wants to trade. But this is fixed and I've given it to you. And now you can decide this number, and based on that, you'll get your risk capital. And this is how you should figure out your maximum risk per trade. And then from there, you should figure out the position size for each transaction, And as I said, in the example that Vipul gave, we talked about a simple transaction, but you can make it more complicated by splitting it up into a scale-in entry strategy. So this is called a scaled-in entry strategy. Okay, by scaling in entries via multiple lots. So what Vipul described, that's a scaled-in entry strategy. But the main thing is there should be a pre-planned scheme, and it should include a stop for the whole position. So you can't violate the guidelines given here. Okay, so that's basically it. All right. So we have discussed one important difference between investable capital and risk capital. This distinction is important because I'm sure you'll all agree that just because we have a certain amount of money available for investing, okay, liquid funds, that does not necessarily mean that we are willing to lose that entire money, okay? Yeah. So invested capital is we just call it invested capital. Invested cap, IC, we'll call it IC, okay? IC and RC. And RC is what you are willing to do. So this is not so much, also this is an important learning, you must keep this in your head, and you have to understand that this is how you protect yourself in the market. If you approach, so what I'm teaching you here is basically my approach to trading, which is a very conservative approach. Now the advantage of this, you can determine for yourself that I am much more, generally I would advise always follow these rules. If you want to be aggressive, you make this figure higher, okay, risk capital percentage higher. Maybe you borrow money and put this, if you want to be aggressive. I'm not recommending all that. But the method that I'm teaching you, you will never go broke, and the market can never do anything to you if you operate like this. If you always operate, and this I'm applying to your, and as we say, that everything we are discussing here, okay, all the principles we discuss here for your kind of trading project here, all of these are applicable whether you trade for an institution, whether you're managing a HDFC mutual fund with thousands of crores to invest, or you're managing your own personal trading account. The theory and the principles do not change at all. Only thing is your personal trading account will be smaller in size. But the logic and the thinking does not change at all, not one bit. Okay? So everything that you learn from an institutional perspective can be applied in a personal setting. In both settings, because even institutional funds can go broke, as you saw in Franklin Templeton, they had some problems. Okay, you saw ILFS having not a fund but a company having problems. Managing risk is a very important thing, and many companies don't get it right. So what I'm teaching you is a very solid approach to managing risk. Okay, if you operate along these lines that I'm giving you, okay, it's very difficult for the market to do anything to you. But understand, market otherwise is quite a fearful entity. It's quite a terrifying entity. As you can see here, how things move in the markets. You saw what kind of a massive drop you had during the COVID crisis. Okay, so if you looked at 5-year S&P, by the way, has also now gone to a new high. The entire gains, okay, 2016. If you look at what happened in the S&P 500, such an important index. So here you have the Trump election. You have all this rally, and in the COVID crisis, in a few weeks, the whole thing is wiped out. Comes right back there, okay, from where it started. So it's astonishing, and now it's back right back there, okay. Already gone to new highs, already made a new high. Nasdaq already did it many times ago. So the point I'm trying to mention, the reason I'm showing you this chart is that the markets, the financial markets, people talk about it very casually. Oh, this will happen or that will happen, as if they know. Nobody knows anything, and anything can happen. So you should have that sense of fear about the market, that the market can totally destroy you if you're not careful, and that anything can happen in the market. But if you operate like this, if you manage your position size in the way that I've shown you, it is very difficult for the market to do anything to you, okay? Because you will survive, because your losses will always be within budget. Remember, losses are not the problem, okay? Losses have to be within the budget. That's what. Because budgeted losses we are ready for. We already know that when we go into this business, we could lose some money, and we are ready for it. The problem is when you don't have proper risk planning, which happens a lot, surprisingly, even in an institutional setting. Many companies go bankrupt because of poor risk management. So it's astonishing, actually, that it happens, but it happens. And because people are not very careful about their risk planning. So what I'm teaching you is my approach to trading. It's a very conservative approach, yes, but I'm giving you this as a benchmark. Okay, if you follow this, the market will typically not be able to do anything to you. You can trade for years. But if you want to be more aggressive, you can increase this number, okay? You can try other kinds of tricks, but generally, if you follow this approach, you will not go broke. So you can take this as a benchmark and then decide how much you want to deviate from this. But generally, I would advocate, don't deviate from it, okay? Stick to it. That will ensure your survival. All right. So we have discussed some of these areas. We discussed the concept of invested capital versus risk capital. Very important distinction: investable capital and risk capital. You need to understand these concepts, and so you can already start applying this in some of your personal trading approaches. Okay, those of you who are doing personal trading. Some of your seniors, for instance, had come to me earlier. They had already invested in the stock market without any plan. So they had already invested. Now they were losing money, and then they were asking me, "So what should I do now? I'm losing money." So this is not the way to do it. Before you enter, you must have a risk control plan, okay, and also a profit-taking plan, which we will see. That's why we are doing the decision problems. Okay, so let's talk about since we are discussing this number of units position size problem, okay, let's also discuss what we had talked about with Siddharth towards the end of the last class, which is that one of the problems you will face, I think we have discussed everything pretty much here, pyramiding, okay, yeah. So let's just talk about this problem. How will you solve it? Okay. This has two parts actually, two scenarios. Okay. Okay. I hope if anybody doesn't understand what I'm writing as shorthand, please ask. Okay. So if you ask, I will change the notes and I'll make it clearer. Okay. Two subdivisions, actually two sub-decision problems. Okay. What are those scenarios? Okay. So scenario one is, so remember we are discussing the question of pyramiding, where we go back to our discussion chart FCX. All right. So we go back to, let's say, 3 months. Okay. Or let's make it 1 year. This is better. Okay. So as you can see, Sachin's initial instinct to buy the stock has turned out to be correct. It has actually made a new high since we started our discussion. So now let's say that Sachin has bought the stock at 11. Okay. Initially, he bought the stock one lot. He bought 100 shares at 11. Okay. So let's now talk about pyramiding. Okay. So initially he bought, let's say, before this, let me define one more point actually, which I have not defined. Market lot. Okay. So market lot is a standardized, this is the technical term, so you should know it because I've been using the word lot. Lot doesn't mean many. Okay. I want to have lots of, bread or lots of rice. No, not lots. Lot means it's a quantity, standardized quantity. Okay. That is determined usually by convention. Okay. Convention means that, tradition, convention. Okay. Usually by convention and standardized trading quantity for which market prices are quoted. All right. In any market is determined usually by convention. Okay. So convention means tradition. Okay. So market law, standardized trading quantity for which market prices are quoted. Right. So that means that, for instance, if you're looking at all these prices that you're looking at when your IB TWS is open, say 1470, market is closed right now. So you have to understand these prices are for market lots. Okay. And as it happens, it will differ from market to market. Okay. Standardized differs. Market lot is usually determined by convention and can differ from market to market. All right. So in the case of Indian shares, you can trade in one share, but in the case of US stocks, the market lot is 100 shares. So these prices that are quoted, these are for market lots, and the market lot as it happens in the US is 100 shares. Now, if you go to Japan, you may find a different market lot, maybe 50 shares, maybe one share, whatever it is. Okay. You figure out when you have to trade a particular market, or a particular jurisdiction, you find out what the market lot is in that jurisdiction, right? So, for instance, when in foreign exchange, when dealers trade between themselves, the market lot is 1 million units. So it will differ from market to market. So you can figure it out. Okay, when you are trading in a market, you find out what it is. Standardized trading quantity for which market price are quoted. Okay. Any trading quantity there's also a term called odd lot. Okay. Anybody wants to define? Let's ask Shubham. Shubham, what do you think odd lot is? I just defined market lot. What is odd lot? Yes, Shubham is sleeping. Who else is sleeping? Okay, let's see who else is sleeping. Let's ask Nikita.
Yes, sir.
Yeah. What do you think odd lot is?
Sir, I don't know odd lot.
Okay. Yes, somebody has raised their hand. Okay. 3 participants have raised their hands. Okay, Utsav, I saw Utsav's hands first. Okay. Yes, Utsav, what is your point?
Sir, I think odd lot is when there is a random mixture of different shares in a portfolio.
Random mixture? No. No, not random mixture. No. Yeah, so I'm not writing that. Okay. Yes. Who else? I'm not able to see. One sec. Okay, I've seen hands. Okay, now let's look at Krish. Let's ask Krish.
Sir, I believe a lot is like if a stock is a stock of 100 lot. So that means one lot where there are 100 shares or 100 shares. So odd lot means
what is odd lot?
Yeah, sir. Odd lot means apart from that, like if a lot has 100 share, then 40 shares may be an odd lot.
Correct. Okay.
The remaining shares apart from the.
Okay.
Yes, sir.
Yeah. Okay. So the way we have to define it with the way we would have to anybody. Okay, Mukul, is yours a question or you were trying to answer this?
Yes. Sir, I was trying to answer this.
Okay, what is your view? How do you want to define odd lot?
Sir, I consider odd lot like as same as the Krishnandan, but I consider that it can also happen because of the bonus share kind of thing. That sometimes they offer shares and they offer only one share per set of shares. So it's like I have 100 shares, now it reaches 121 shares or something suddenly.
I understand what you're saying. We are not talking about the reasons for odd lots. I'm asking you how do you identify or define an odd lot? You see, everything we are trying to define in a fairly tight way. So in definition, you agree with Krish?
Yeah, I agree.
Okay, what is Rag saying?
I was saying, like, for example, someone is holding 60 shares, and then after some time, there is the lot changes and the lot size is 100. Then that person's shares will be considered as an odd lot.
Okay, so you're the same as Krish. Basically, you're saying the same thing as Krish, right?
Yes, sir.
Okay, Vipul? Yes, Vipul.
So basically, sir, if the standard size of a lot is 100, and if we buy suppose 40, and we considered it as a lot for our own, then it is considered as an odd lot.
Okay, so similar to Krish, basically, same thing, right? So we'll just go through all the hands. Sachin, what are you saying? Anything odd lot definition, is it different from Krish?
No, it's the same. Just less than a normal lot.
Okay, so it may not be less, but it's okay, fine. So let's define it. Remember, everything we have to get into the habit of defining it in a very precise manner. Okay, so odd lot will have to be defined as any trading quantity. You see how definitions have to be written. Okay, I'm just creating these definitions. It will be difficult to find good definitions like specific definition. Any trading quantity which is not an integer multiple. You understand what integer multiple is? Any trading quantity which is not an integer multiple.
Decimal points.
Sorry?
So decimal points, integer multiple, if not an integer multiple, then a decimal.
Zero. A decimal is zero, basically, right? So, yes, you agree. That was Utsav, right?
Yes, sir.
Yeah. So, integer multiple is basically that if you have, say, for instance, 857. Now, 857 is not an integer multiple of 885. So, because 857 divided by 85 is 10.0. I'm not getting 0 decimal. Okay, that's what I'm saying here. this is not, so 857 is not an integer multiple of 85.
Can I explain?
So, but 850 will be an integer multiple, because if I do 850 divided by 85, I get a roundabout, no decimal. Okay, I can test it, no decimal. Obviously, we know this, but is this everybody understands this? So you have learned. I think you know this term, but still we need to be clear. So how do we define odd lot? Any trading quantity, okay, which is not an integer multiple of the market lot. All right, the market lot is 100 shares. In this example, if you take 85 as the market lot, you say that if you are trying to trade, okay, trading quantity or order quantity, okay, trading or order quantity, because you will send an order into the market, okay, which is not an integer multiple, then it becomes an odd lot order. And then you can say that, you can also say that this 857, okay, has 10 market lots, and then there's an odd lot of 7 shares. But you can also refer to the whole thing as an odd lot. So this is how we should define odd lot. Okay, is everyone clear? I hope everybody's clear about this. So any which is not an integer multiple, then you get an odd lot. So this is basically it. All right. So we need to understand, because market lots and odd lots, these are all terms that are used. And market lot, as you have to understand, market lot is different in different markets. All right. Futures markets, oil futures, crude oil futures, the market lot is 1,000 barrels. You can't go in there and say, I want to buy 357 barrels. You have to trade in 1,000 barrels. So the price is for the market lot. All right. Now, what we had used the word lot. Actually, we were in our discussion of pyramiding. Okay. That's why I went to the definition of lots, because I'm using this technical term lots, and I wanted to make sure I define it. Okay. So the pyramiding scenario can be two pyramiding scenarios, which is scenario one is that I'm just going to use the one word, previous lots. This implies multiple lots. Okay. Stopped out means stop loss is triggered. Okay. Okay, so I'm using a lot of terms. If anybody does not understand anything at any point, you have to ask me. Otherwise, you will get lost. Okay, this is quite a technical subject, and unfortunately, I have to go at a very in a very unorganized, disorganized manner, because I need to give you the skill set to trade, so that it's not really going in a good sequence. All right, I just need to make sure that you can solve everything. Previous stop lots, if stopped outs, stopped out. And stopped out means that your stop loss is triggered. Okay, that's what stopped out means. Stopped out means that stop loss is triggered. Okay, that means the market goes through the stop loss. Previous lots of style, I'll write it first, then I'll explain visually what I'm talking about. Previous lots, if stopped out, here. So when I say previous lots, I'm talking in multiple terms, plural. Okay, this includes the idea of singular, which is only one previous lot. Okay, so I'm using it this way. So just get used to it, because there could be multiple lots, and in case you have only one previous lot, then you treat it as singular. Okay, but plural includes singular, but singular does not include plural. So if previous lots, if stopped out, the first scenario we're talking about, if stopped out, okay, would not generate net loss. Okay. Let's say I'll write this in a slightly better way initially, but let me explain what I mean. What I mean is this. So initially, Sachin buys 100 shares of FCX at say 1150. Okay. So initially he buys, this is for the market lot discussion. We should just put a little, and this is like our board, okay? We have these boards for, we have one more here for the day. I'll put in the date here. This is our market lot discussion. You can just put a little one here. All right, now next discussion is on this pyramiding, okay? So, all right, so let's have this discussion on pyramiding. So we are talking about scenario one, okay? So initially he buys, okay, say 100 shares at 1150, all right? So 100 shares at 1150, and his exit price shares at 11, exit on loss. The exit price plan was he buys at 1150, okay? Exit price, I'm just using approximate terms, is 9.7, let's say, okay? 9.7. We'll just call it a stop loss, okay? Understand what this is. That he bought 100 shares at 11.5, and his plan was that if it goes below this low, you're also getting an idea as to how you can select your stops. Just pick the new low. We'll explain all this later why it's done, but for now you can just practice it. Just pick the low and then put it. If you're going long, just pick the previous low and put the stop below the previous low. Okay, then I'll explain the logic for this. There's a logic for that actually that I'll explain later. So what Sachin does, 11.5, he buys 100 shares of FCX and he puts a stop at 9.7, right? So initial stop is 9.7, right? So now we don't have to calculate the loss. Now what is happening is, now we have scenario one. Okay, so S. All right, now scenario one, what is happening is, now the market has gone to, and we are going to assume here in this entire discussion, we are going to assume that all entries are done at market prices, okay? That will simplify our decision problem. If you remember, when you are talking about the entry price decision problem, we said that there are three ways to solve it. I think that's in a different, yeah, you have it. There are three ways to solve it. You can enter at a market price. You can put in a limit order and enter at a price more favorable than the market. Or you can put in a stop order and enter at a price less favorable than current market. It should be the current market, just to be clear. Market always means current market. At that time, current market, whatever you're referring to. But just to be clear, I'm making it, it's a redundant kind of use of the language, but I'm just trying to make it extra clear. So you can see that entry price you can solve in three ways. Either entering at current market, or you have the other two options. So here we are going to assume for this discussion, we are going to assume that all entries are happening at market prices. Okay, so entry price decision is being solved this way. So the new market price, okay, number of shares is 100. Entry price is is 11.5, and the stop loss target is 9.7. Okay, so we have a new scenario one where the market price is, let's say you bought it at 11.5. Now the market price has gone to 14.7. Okay, so this is the market price. Now the new market price is 14.7. Right. All right. So this is written under entry price because we are assuming that all entries are going to be at market. All right. or we can actually write it as a separate column just to be more flexible. So let's write this as 14.7. The new market price is 14.7, right? And in this case, he will also enter at 14.7. So this the policy is always to enter at the market. Now, what is important in scenario one is what makes the difference between the scenarios is partly this, the entry price on the previous lots, and the new stop. Okay, and what is the running stop? Now, there is always only one stop. Okay, so we are discussing here. All right, so we are discussing here, let me just write some of the assumptions here, okay, that the pyramiding decision, we are discussing all entries are at, so it will not change the, it will not change the solution method or anything if we decide to enter using limit orders or stop orders. But we are just using this for simplicity. Okay, all entries are at current market prices. That means we are using market orders. All right. Okay, that's one assumption. The other assumption is I forgot what I was going to say, but anyway, we'll figure it out. Okay, I'll remember it. Okay, so all entries are at current market prices, and so this is the other one. So the other point I'm thinking that this is an important assumption. There is only one stop loss at any point of time attached to all previous lots. Okay, I'll explain what I mean. I'm also writing it down so that later on when you study it, you can refer to this. There is only one stop loss. Yeah. This Google AI, whatever they're doing here, this is pretty smart stuff. They really are able to detect your when you write in a hurry, you have grammatical errors. They're pretty good at this stuff. Okay. So the second assumption is that there's only one stop loss at any point of time attached to all previous lots. Okay, this is an important assumption. Okay, what do I mean by that? What I mean by that is that initially the first lot Sachin bought at 11.5. Now the market has moved to 14.7. He wants to buy another lot. Now he will obviously have to set a stop because remember you can't buy all these restraints I put on you. I've given you this guidance, follow it for life. If you do your position sizing like this, the market can never destroy you. So he knows that when he has to enter a position, he needs to also pre-decide the stop, okay, exit with loss. So he needs to decide the exit with loss for every trade. So what Sachin decides is following the same rule. The same way that he decided when he was entering here, the low was over here. So he put the stop at 9.7. Now at 14.7, he will put the stop here, which is, I just got to use rough, around 13.6. Okay, so we'll put it at 13.6. So now he has to put this at 13.6. So the new stop loss will be 13.6. All right. So is everyone following? So the stop loss means basically that you give an instruction to the system that at 13.6. So Sachin will buy at 14.7. As soon as the market goes below 13.6, the system will sell his shares. If he buys one lot, 100 shares long at 14.7. If the market drops, because we don't know what will happen, it can go up or it can go down. If the market drops below 13.6, then he will, the system will sell his shares because he put a stop order at 13.6. The system will sell 100 shares for him at market, and therefore, assuming it gets done at the same price, so he will be out of his position. His position will go to zero, and he would have lost. This will actually will be slightly bigger than that, but we are assuming that it's done at the same price and there's no brokerage. So then he has lost 14.7 minus 13.6, 1.1. into 100 shares. $1.1 into 100 shares. Okay, that's what the idea of the stop loss is. I'm just repeating it once again in case somebody doesn't understand, because the because there's one second. Yeah, Mitali, can you switch off your video? Because we want to just make sure that everybody's video is switched off. Yeah, okay. So, all right. Now, so what Sachin is, the situation we're describing, first scenario is that we have, he entered at, this is the basics setup, 11.5 he enters with the original stop here. Now we're talking about scenario 1 where the market is at 14.7 and the new stop is 13.6, okay? Now remember we said that there is only one stop loss at any point of time attached to all previous lots. What does that mean? That means that his first lot is at 11.5 purchase price, second lot purchase price is 14.7. But because there can only be one stop, the stop for both the lots is 13.6. All right? Is everyone clear about this? This is what I mean by this statement. Okay. So now Sachin will have to move his stop for the first lot, which was at 13 point. He'll have to go into the TWS, edit the stop order price, okay, trigger price. You can edit those prices. You can edit the price and he will change the price from 9.7 to 13.6. And then you'll enter a new trade at 14.7 with the 13.6. Now you've got two lots. Okay, this one has risk, and this one is entry at 11.5 and exit at 13.7. All right. So as you can see here, okay, I'm going to go a little quickly. Ordinarily I'll be asking people, but because we're running short of time, I'm going to go a little quickly. As you can see clearly that on the first lot, even if the stop is triggered, he will not suffer any loss. Okay, this is what I mean by this. Scenario 1, previous lots, if stopped out, okay, would not generate net loss from a starting point, from the starting point. Okay, that's what I mean. This language is not very pretty. I'll have to change it later, make it more technical. But you understand what I mean. Starting point was here when he initially put on the trade. 11.5. Here there was what we call open risk. Okay, here there is risk. Okay, because if 11.5 and 9.7, if this stop is triggered, he will actually lose money. But entry at 11.5, exit at 13.7, even if the stop is triggered, he's going to lock in a profit, not a loss. Okay, so this is what I meant by scenario 1. Okay, in this case, what would happen would not generate net loss from the starting point. Okay, here, let's make it any net loss. All right, I have an alarm for the end of the class. Here, entire risk per trade amount. That is, we're talking about this figure. Yeah, maximum risk per trade, 4286 that we discovered, that example. Okay, entire of this amount can be applied Okay, so the new lot is basically when Sachin has to decide, he has already decided I'll buy at market, but he still has to decide how many shares can I buy. Okay, that question, position sizing question, to decide that, he will again have to apply this kind of logic here. And for that, he can apply the entire 4286 to do this calculation and figure out how many shares to buy on the second lot. Okay, that's what I'm saying. Simple thing. The other scenario, scenario 2, is that I'll just copy this and then I'll rewrite it. Okay, scenario 2 is here the previous lots would generate some net loss. Okay. This is called, we call it open risk. This is also a term that you need to learn, open risk. The opposite of open risk is closed risk. Okay. So what is open risk and closed risk? We can use this term here, and I can just briefly define it here. Open risk is nothing but where you have actual loss of risk capital, okay, from the starting point. 11.5 entry, 9.7 stop. Here there is open risk. But the 11.5 lot, when you've got a new stop at 13.6, here there is no open risk. This is called closed risk. Okay, this risk from dropping from 14.7, getting stopped at 13.6 for the lot that was bought at here 11.5. This risk here now is closed risk. Okay, open risk, not closed risk. Okay, yeah, let's just put it open risk here. I'll just define it later on. I'll put the idea. So this is called closed risk. So in scenario 1, this is scenario 1, whereas our scenario 2, previous loss if stopped out would generate some net loss from the starting point. Okay, so second scenario is, I'll just define it quickly. Second scenario is where let's say we take a different case. Okay, suppose he buys at this. I have to define a case where let's say for some reason that when he buys, let's say the loss is the new stop is at 10.3 for some reason. Okay, let's say he buys. Your class is over, but I'll just take some. Just give me a second. Okay, and I'll explain this. Then I won't get into this further. I'll just take 2 minutes to explain this. What I mean is that let's say that he buys at 11.5 with the stop here, first lot. Then it goes to 11.9 and he wants to buy another lot. Okay, but the stop has now been moved. So the next lot, if we just take scenario 2, okay, I'll just quickly do this. Okay, and scenario 1 is, this will be scenario 2. In scenario 2, what is happening is, your second lot entry price is going to be 11.9, okay, and the new stop is, as I said here, the new stop is just below this low, which is 10.3. Okay, the new stop is 10.3. So the difference in scenario 3 is, in scenario 2 is that even the first lot, even the previous lot, if stopped out, will generate some net loss or open risk from the starting point, which means what is happening is, in when the new stop is at 10.3, it's better than 9.7. So 11.5, this loss here, the loss 11.5 to 10.3 is not as much as here to here, but it is still some loss. Okay, in which case what you have to do is, I will write this down later and I'll explain it briefly and then I'll leave you guys. That here what is happening is you have to now figure out how much will you lose on the first lot. Okay, so here the risk per trade amount that can be applied to size the position for the is has to be, let me just write it this way, adjusted downwards to reflect potential loss on previous lots. That's all I'm saying. Okay, so if you see the case that if you find that for the previous lot, okay, we are not doing the calculation, but we can say in this case 11.5 minus 10.3, okay, you're losing say 11.5. In this case we have to take exit minus entry. All right, you're losing this amount. Okay, 1.2 into 100 shares. Okay, so you do this calculation and then you deduct this amount from the risk per trade, because you ordinarily have this much per trade. Okay, but you're going to lose this amount on the first lot. So on the second lot, how much can you put on? That will be determined by deducting this from this figure, deducting the loss on the initial trade. I think everybody has understood what I'm saying. Okay, so the maximum risk per trade is actually the risk per stop loss for an individual stop. Okay, and all positions are run against only one stop. Okay, If okay, rest of you can go. I've taken 3.5 minutes. Rest of you can go. If anybody has any doubts about this, please stay back and clarify it. And Gaurav should also stay back. First, I'll talk to you about your. So the rest of you can go. Class is dismissed. Okay, Gaurav, can you just stay back and tell me about your technical problem?
Sir, I am actually going to mail them today.
So you might want to wait. You might want to wait. I've asked that girl about your problem, and let us see what she says. When I hear from her, I'll email you, and then you can do it.
Okay, sir. The problem I was having every time I was trying to log in, the error message was coming, which says that incorrect password or email ID.
Yeah, I saw that. I saw that. Okay, let's wait for tonight. Okay, now anybody else? Now, whoever does not clarify, I'll assume that they have understood what I'm saying here. Okay, pyramiding has two scenarios that we should deal with, and how you decide. Remember, this whole thing is all of this discussion is basically required because Sachin has to decide. Now he has decided that I will buy more at 1470. Okay, because he always trades at the market price. He already has a historical lot at 11.7, but he still needs to decide what will be the position size for the new lot. Okay, that is why to answer that question, you can have two scenarios when it comes to pyramiding. Okay, and that's why we need to go through this exercise. That it's the same logic, the system is the same, but if you have previous lots which are going to generate losses, you better make sure that you don't lose more than this amount on each stop. Against all positions should be run with one stop, okay, for any given trading system. All right, and for each stop, this maximum risk per trade is actually the risk per each stop. Okay, 4286 in our example, that should be riding on this. When it was riding on this, it was still 4286 riding on this. Now that the new stop is here, not more than 4286 can be riding on this. This is clear? Everyone is clear? Understood? Anybody, any questions? All clear? Okay, then everybody, you could have already gone anyway. So I'm going to end the class. Is that okay?
Sir,
Yeah,
excuse me, sir. Srishti this side.
We will come to Opat. Yeah. First Srishti, yes.
Yeah, sir, I entered the meeting 4 minutes late due to some because there's some issue. Sorry, there was some issue with my Zoom ID, so it took me around 3 to 4 minutes to enter the meeting.
Okay. I'll have to talk to DG sir about this because this becomes a problem later on. Okay, yes, Ummat, what is your problem? Okay, so yeah, Srishti, you don't have to worry today. Okay. Yes, Ummat, what is your problem? What is your question?
Sir, actually, I want to understand that how order lots will affect my decisions. Like odd lots will affect my decisions. Sir, like what is the relevance of odd lots?
So odd lots, in this case, you are not going to be trading in odd lots. Odd lots, I only introduce that term because I want you to know the terminology. That just like there is a concept of a market lot, and when you deviate from that, you have a concept. So you should know both the terms. Okay, that's why. In this case, you are not expected to trade in, generally it is not advisable to trade in odd lots, but you should know what the term means, that's all.
Okay, sir. Okay. Thank you, sir.
Yeah, okay. The rest of everybody else has understood. Any questions? Any other questions?
So I emailed you regarding the problem with the software.
Yeah, you sent an email. Let me check that email. What is the problem that you have?
So that I traded with certain tickers, and then out of the blue moon, when I opened my software on a new day, it was showing an opening negative.
I got that. Okay. The second part I already solved. The second part you have to understand is that those the PNL calculations are being marked to market on a daily basis. So which means if you bought something here at 944, and at the end of the day the market has gone to 11.4. Now the system will show a profit and then will show you as being long at 11.4. It will give you the realized profit of 9.4 to 11.4. Okay. And it will now show you as being long at 11.4. So the next day when the market drops to 9.8, it will show you as having a loss. Okay.
Yes, sir.
Even though 9.4 to 9.8, you're still actually in a in a profitable position. But because it now considers you as long from the previous night's close.
Yes, sir.
Okay, that's the second part. And the first,
Yeah, yeah.
what was the first part? I don't remember. I remember reading the email, but I forgot what.
So there was a image that I attached in the email. In that, it was showing a negative opening position, even though the position was zero. And later on, when I actually tried to like compensate with the negative opening position to close the position, then it started showing the positive position irrespective of zero.
Okay, now this is the more complicated thing. I'll have to actually look at the actual situation.
Yeah.
Maybe we can try to, let me try and log into your account. That position is still there.
Yes, sir.
The problem is still there.
No, no, the problem is still like okay. The problem is sometimes there, sometimes not. Like yesterday, I checked it. Yesterday, it was again showing negative position for certain stocks, which I already taken and closed a long time ago.
Any particular stocks?
Yeah, a few particular stocks. Like it can sometimes show with AES and HAL mostly.
Okay, okay. Let me check your account then. Give me some time. Let me check. Maybe we can talk about it next week. Because tonight is Friday, so you may not be able.
Yeah,
to.
sure.
Okay, I'll have to check it first. All right, let's do that. But the second part you have understood.
Yes, sir. I understood. Thank you so much.
Yeah. All right. Anybody else? Any question?
Oh, sir.
All okay. All right. So we can finish off. Okay. So Gaurav, I'll email you once I hear from this girl.
Okay, sir. Thank you so much.
All right. Cool. Take care.